morning. Thank you so much for joining us. For the last couple of trading sessions, we have seen that commodity prices have seen quite a bit of spike. Of course, they are off their highs considerably so. But what's your expectation? Where are we in this commodity cycle? Are we closer to the top, or is it time that it'll start going downwards from here on?
So we have seen a decent correction in most of the commodity prices, and now prices have kind of stabilized at these levels. Currently, energy prices are still very high, especially coal. And don't get misled by the negative gas prices in Europe. That's because there's no storage out there at the moment. But the storage capacity itself is not that large. So come winter, and if this winter is severe, probably energy gas prices will shoot up again. Coking coal prices have actually inched up to $300 from after touching almost 200. So we are kind of stabilizing at current levels because energy prices are still high, and if and when energy prices correct, we'll see the second leg downwards for commodity prices. So till that time, I think it is kind of status quo. The results which have been coming out has also been pretty weak, but the silver lining is that probably margins have bottomed out in Q2, and in Q3 there is going to be some recovery. So that is the hope which is pushing commodity stocks a little bit up, but I don't think it's going to be a massive rally. We are going to be in a trading range only.
Rakesh, last time around, when we saw this commodity rally coming in, markets were factoring bankruptcy for a lot of companies. And that's why you saw a very phenomenal move as prices started to rally and cash flows started to become very strong. Which kind of companies would you prefer this time to invest in?
So, Pankaj, you made a very pertinent point. Valuations these times are not factoring in any kind of bankruptcy because balance sheets are way stronger. So, I don't think we have that benefit of very low valuations to enter here, and neither there's an upcycle looming at the horizon because recession is still a big risk, and demand slowdown is ahead of us. So, I don't see any major upcycle coming in. Neither the valuations are cheap. So in that scenario, you stick with people or companies which are having a decent balance sheet, high ROEs, and who don't really do too much of capex. So some of the mining companies actually fit that bill better as compared to steel companies or aluminum companies.
So mining companies is what you would focus on. How would you essentially, look at a lot of these companies which have started to pay dividend over the last 2 to 3 years because, cash flows have been pretty strong of consideration?
So dividends are definitely going to go down. So you can't really benchmark FY22 payouts with FY23, etc. I think just backing on what they paid in FY22 may not really be the right approach. But as I said, companies with cash-rich balance sheet and not looking to do too much of capex is where I would hide in this metal space.
All right. In terms of really what's happening in terms of metals, where would you see valuations now versus, earlier there was 0.4 times price to book value when they really started to rally. What are the valuations now on a price to book basis for the sector, and where can it go? Say if a blue sky scenario is priced in.
So Pankaj, as I see elongated period of low commodity prices, prices sticking around at these levels, and the margins sharply lower than what it was in FY22. So I think the range for price to book for commodity stocks would be between zero point 0.7 to 1.5. So I think that's the broad range in which most of the commodity stocks will trade. Currently, they are closer to 1 time or slightly ahead of that. So they are in between zone. So there could be a little bit of bounce, but not really play into that because I don't really see an upcycle into commodity prices going ahead. If you look at the broader, larger framework, most of these companies are doing like 13-14% ROEs. So for that, I think 1 to 1.2 time price to book is kind of fair number.
Okay, fair enough. But I was going through a CLSA note which pointed out how Hindalco, for instance, is trading at quite a bit of discount to versus the historical averages when it comes to the mid-cycle premium that it really used to garner. And the risk reward per them is favorable. What's your pecking order? Is there any stock wherein valuations look attractive and leave the room for upside?
So, I mean, as I was saying that most of the stocks can have a trading bounce. But where I'm more comfortable is, as I was saying, mining companies. So iron ore is one space where I'm more comfortable with. Here, the cost structure of the Indian mining industry, iron ore mining industry has changed, and costs have increased by 1,500 rupees per ton. And this gives a huge advantage to the incumbents who are still in the old regime. So there are a few companies like NMDC, Godavari Power, and Ispat, etc., who are still at the old regime and have this massive competitive advantage. And all these companies are cash rich. So I think this is the place where people can probably look to hide. Converters, etc. I think I'll wait for more clarity on the global economy before we jump into those converters.
And Rakesh, since we have you with us and you're a keen watcher of the entire cement pack as well, what do you make of the earnings so far? Do you think this was a bit of a washout on expected lines, but from here on you're expecting considerable improvement? What's the best way to play the cement space as of now?
Yeah, so cement space is similar to metals. They have also seen their earnings bottom out in Q2, and Q3 promises to be much better. Also, you don't really have to worry about the global problems. So I think cement is a better place to be in, and the cost reduction possibility for some of the companies is looking pretty good because they are moving into waste heat recovery, power plants, and the recent takeover of Ambuja is also auguring very well in terms of reducing costs because Adani has all this expertise in logistics and power and green energy. So I'm much more bullish on cement and cyclically also. Normally, it is best time to buy cement in October and sell in Feb and March. So cyclically also, I think stocks are well poised.
Cement stocks at least are well poised both in terms of cyclicality plus the fundamentals look a tad bit better because the worst seems to be over. Thank you Rakesh for joining us and
Thank
talking
you.
to us about the entire metals pack as well as what's happening in the cement space. But talking about what's happening in the market at the moment, 17th